Did you know there are many ways to fund your life insurance policy, and some are better than others? So stick with me. I'm going to share with you the do's and the don'ts so that you know all the things when it comes to funding your life insurance policy. All right, so let's start with the don'ts, right? Because here's some big warnings I want to give because there's a lot of information about infinite banking. A lot of times people are telling you to use money in this and that and the other. So I'm going to give you 3 do nots first. 1, do not buy the high cost policies. So what I mean by that is there's whole life policies, they are front loaded. All the costs typically show up front and then it gets cheaper over time. Opposite of term insurance, right? Term insurance is cheap up front and it gets more expensive as you get older. Well, with whole life, those costs up front can really cripple your ability to save up money in there. Do not buy the traditional whole life policies, the same ones that the Dave Ramseys of the world hate, right? I agree with him on that. Do not buy the high cost ones where all of your money is going to cost in the first 2 years. I don't like those. I like it when you have what's called paid up additions. You have money that's going that's extra, allowing it to do it. But to do that, you have to make sure you get a policy that actually has the lowest cost with the highest ability to fund it possible. That usually only happens with our max ROI infinite banking policies, not the traditional ones that you usually buy. So stay away from those high cost policies where your money is gone within the first few years. Number 2, this is a big one, is do not use debt to fund it. There are some people out there that will tell you, hey, you can use debt. It could be credit cards you use to fund it. You can use your home equity lines of credit to fund it. Now, home equity line of credit, maybe. There are a few people that if I knew they were really good savers, they weren't spenders, they weren't blowing their money a lot, there were some people I'd say, you know what, you could use it. But understand that there's a payment involved there. That if you take out money using debt to fund it, you got to make that payment to that debt. And then on top of it, you're still adding funds to that policy. So doing that year after year doesn't really work because like I said, if you buy those high cost policies, if you use debt to fund a policy where all of it goes to pay for the costs, that's not a good thing. Even policies where they say, hey, you'll still have 60% of your money in the first year. 60%, 3/5 of it, not really worth it, right? Even in my case, where usually when we dump money into policies, you usually have at least 75 to 80% from day one that's in there. Even then, I put a lot of hesitation behind it. So be careful not to use debt, no matter how creative they say they make it sound. And I've had a lot of people say, well, I was told by this guy because you're able to borrow it and do this and this and you make money. Now, keep it simple, use your own savings. And that leads me to the 3rd do not, which is do not dump in all of your cash. Some people get excited about this and they say, oh my goodness, this makes sense. It's a no-brainer. I can see it. I can double dip on my money, making my money work in 2 places at the same time. I'm gonna take all my cash making no money and dump it in here so it's making something tax-free. Well, that's an option, but I don't think it's a very good option. There are some guys out there that teach about infinite banking, right? This is why we're not all the same. They'll teach about infinite banking. They'll say, yeah, well, dump in 100,000, 200,000, 500,000, and then pay very little after that, right? Just put a big dump of cash in there. Why do they say that? Because it makes their commissions much, much bigger. It pays them more money, not you, okay? Do not do that. Do not dump in all your cash. That is a dangerous thing that really just puts you in a policy locked in with some higher minimums and that just, it creates real high risk, even if it's set up the right way, even if it's set up like with us. Generally speaking, we wouldn't recommend you dumping in all your cash. So what do you do? All right. Well, instead of dumping in all your cash, you're going to use the money you're already saving in the first place, right? So money that you're either putting into your savings account that you're trying to build to invest somewhere else, money you've been adding to other investment accounts, money you've been adding to 401ks. Many of our clients will stop funding their 401ks because they realize locking it up there doesn't give them any freedom. But they can put money here and then turn around and use it short term to invest in other things that generate passive income. That's awesome, which is my 2nd do, is use it to invest for passive income or invest from passive income, okay? But we'll come back to that one in a second. So use the money you're saving already. So I had somebody recently that they said, hey, I'm saving about $2,000 a month between everything that I'm saving. That's $24,000 a year. Here's what I recommended. The max that I said they should put in is no more than about $18,000 to $20,000 a year. Sometimes even more like $15,000 to $20,000. Why? Because I don't want you putting every single dollar that you have extra put in there because life can happen. Weird things can happen. Unexpected events can occur. It could be good events, but a lot of times it could be bad ones. It could be you have an unexpected expense in your life that ends up taking the cash you would have used otherwise to fund it. If you have this big funding amount that you're trying to fund, that's not good. And if you buy the traditional whole life policy where they're high cost, that $20,000 max, if you try to put that in there, is your minimum. If you can't keep paying $20,000 a year, you're in trouble. Now, the way we design it though, it's different Because when we talk about putting in, say it's $20,000 a year, the minimum, the actual required premium is much, much less. Usually it's 1/4 to 1/5 of the cost. So if it's $20,000 a year, usually our clients only are required to put in $4,000 or $5,000 a year. So think about this. If you're already saving $2,000 a month, $4,000 or $5,000 a year, you can already save in a couple months. So it's easier to be able to meet that minimum. But you can save in all the way up to the maximum of that $20,000 a year. But again, we never want to try to put every dollar possible into these life insurance policies just to give you some flexibility and some breathing room. So one, you're not putting in the max of everything you're saving. And then two, even the minimum required premium is much, much less than what you've been saving. Does that make sense? All right, so that's the key thing is use your savings that you're already investing already. That's the money you fund into it each year. Number two, when I said using money from passive income, one, we like to use it to create passive income. But secondly, or thirdly, whatever number I'm on, right? The thing is we want to use the money from passive income to also be able to buy into possibly even more policies. So let me give you an example here. I had somebody come to me, he was a real estate investor. He said, Chris, I've got $80,000. Should I just dump all that in the policy? So he's talking about dumping in all the cash, right? And somebody even told him to do that. Another infinite banker told him to do that. And I said, well, it depends. Are you planning to use this money for anything? He said, yeah, I want to invest it. I said, interesting. How much of that money do you need to invest? He said, I need about $71,000. Well, knowing that even in our policies, even though we get the lowest cost possible compared to all the policies out there, I said, listen, if you dump in all 80,000, you're only gonna have roughly about $60,000 you can use. So you're gonna be about $10,000 short. So I said, do this instead. Even though it pays me less money, do this instead. I said, instead, let's only put in about $35,000 a year into the policy. That's the max you could put in. His minimum only being about $7,000 a year. Put in $35,000 a year. The other $45,000, there we go. Then the other $45,000 you take, use that to invest, add it with the money that you already have. There's about almost $30,000 in there. You've got more than enough to do that $71,000 investment. So do a smaller policy instead. So I actually talked him down from the kind of policy he wanted. And it worked perfect. He was able to still do his investment, make money, and use money from the passive income. Because here's the cool thing. Now he's got that money investing in that passive investment, that $71,000, say that that's making him 1% a month, right? Or $700 a month. That's $8,400 a year. Guess what? That helps fund his policy that he's already putting in $35,000 a year. Plus he's already saving that much anyways. So it actually helps him pay for that policy into the future more easily. Even if things happen, even if disruptions happen, he can at least pay for his minimum. Another example, I had a guy come to me, he was being talked to about infinite banking, and the company he was talking to was a decent company. They do a good job, just not the best job. And they were talking about him putting in at least $200,000 a year. They were even saying maybe you should dump in $500,000 because this guy had $2 million. They said, look, you can dump in $500,000 for a few years and then bring it down to like maybe $100,000 a year. I told him, I said, no, don't do that because that just pays them more money. I said, in your situation, you're already saving at least $200,000 a year, right? He's like, right. I told him, based on you having $2 million, I would be okay with you doing $200,000 a year, doing that full amount you're saving. He's like, oh, but Chris, that's all I have. I said, yes, that's true. But think about this. Of your $2 million you have to invest, you take $200,000 out, you do your first year's dump into that policy, that first year's payment, right? Which allows him, by the way, to already have over $150,000 of cash he could use right away anyways. So he's already got $150,000 here. But he's now got this $1.8 million that he can invest. If he only made 10% on that $1.8 million, guess what he's making? $180,000, which is almost exactly what it costs to do here. So he's already saving $200,000 a year. You add that $180,000 on top of it, he now can save $380,000, yet the maximum amount for that policy that he's doing is $200,000. His minimum on that policy is roughly about $65,000 a year. Actually, no, take that back. The minimum he's actually invested, he can put into that policy is about $50,000 a year. So he's making $380,000 and all he has to do is fund at least $50,000 a year. Piece of cake, right? That's the key, is that you can use money from that you're already saving and money created from more passive income, combine that together, and this thing can fund itself easily for years to come. Now, if you thought this was great, guys, let's go a little bit deeper. Let's talk about that passive investing and share the video here called How to Achieve Financial Independence and Retire Early. Check that out.